Welcome back. We have been discussing on Indianomics what is the impact of this huge deflationary force that China is unleashing by exporting in quantity and at very low prices. What impact can it have on global growth, on India's growth, on Asian growth? I've been speaking with Neelkanth Mishra of Axis Bank and Chetan Ahya of Morgan Stanley. Gentlemen, thank you very much for your patience. Neelkanth, what is the sense you're getting about Indian growth itself? Can it get impacted? For that matter, even global growth, can it get impacted by this trade war?
Let's start with India. I think India, I mean, I agree with Chetan. I don't think we are, there is, of course, there is a very high trade deficit versus China. Some of it is an inevitable consequence of the Indian integration into, say, the electronics value chains. So we will import a lot from China in terms of components, and then we will export a lot to the developed world in terms of phones, for example. So, but beyond that, I think the direct impact is more on investment intentions. Remember that we have seen over the past 1.5 years an acceleration in growth assumptions, or I would say an upgrade in growth assumptions.
Yeah.
So from 5.5% that people thought would be the post-pandemic growth for India, we've reached 7%. For us to reach 8%, remember that the increase in labor input cannot expand. I mean, the growth pace at which labor is growing cannot accelerate that fast. Total factor productivity growth cannot improve that much. So the only way to go from 7 to 8 is to increase capital formation or accelerate capital formation. Capital formation from the perspective of real estate, I mean, is independent of what happens in China. Frankly, if steel prices fall, cement prices fall, or let's say commodity prices in general are lower, that should actually help. But beyond that, I think the biggest headache or the biggest challenge is going to be that Indian firms will be apprehensive in adding capacity. And also, remember that the last time we saw near 8% growth, which was the FY3 to 8 period, our exports of goods and services were growing much faster than they are now. And in a world with muted demand growth, I talked about how weak global retail sales are, and China continuing to gain share of global manufacturing. I think that because they are over-indexed on the things that are growing in demand, which is energy production, energy storage, and use of that in mobility or semiconductors, their global share of manufacturing will continue to rise. In which case, it becomes even more difficult for Indian firms to. So it is more a kind of a ceiling to growth or a headwind to growth that you are seeing, and therefore getting to 8% will require a lot of hard work on the policy side in India.
Yeah, so exports will be one gate close to us, and possibility of private capex getting worried, getting uncertain because of the deflationary forces. Chetan, now the big one. If there is indeed a Republican government, which certainly cannot be ruled out, is now seeming like at least a 50% chance, if not more, then what happens? Do we see more rerouting out of China? If there is a 60% tariff, does it mean countries like India, Vietnam benefit? Or is it going to be all told, uncertainty and slow growth?
So I think, Latha, we have basically taken an approach to think about this in two scenarios. Number one is where the US decides to put tariff only on China. And then the second scenario in which that the US decides to put 10% tariff on the rest of the world, in addition to 50% tariff on China. By the way, former President Trump did clarify in a recent Bloomberg Businessweek interview where he said that it is 50%, not 60%.
Okay.
So we have changed our operating assumption to 50% tariff instead of 60.
Okay.
But basically the key point that we are making is that if it is just tariff on China, maybe we may not see that big a negative impact on the global economy and therefore, global trade and India or China's exports. The reason why I'm saying it is that when we saw what happened in 2018-19, despite 25% tariff on China's exports, China's market share in global goods exports did not go down. It was flat, and then actually after 6-7 months, it started to rise.
Oh.
So what really happened is that the global corporate sector confidence got impacted significantly. Corporate sector literally just froze in their decision making at that point of time, and that resulted into global capex slowdown, global growth slowdown, global trade slowdown, and that weighed on everybody's exports, including China. China did not get affected out of proportion. So the key call that one needs to sort of make is corporate confidence going to be impacted in the same manner if it is just tariffs on China? Our initial thinking right now is that probably it may not be as bad as 2018-19 because now every company knows that this is the relationship that US and China has.
Okay.
And it has been already told to everybody that this is coming. So but if it is 10% tariff on everybody else, then you'll probably have a significant impact on the global corporate confidence, and therefore the downside to global growth as well as Asia's exports might be similar.
Okay. Completely out of time. Neelkanth, in 10-20 seconds, can you say what can be India's strategy, policy prescription?
We need to first have a strategy. I think that would be the shortest answer. That there will be points at which you have to take advantage of. If China wants to blow up capital on some things, then you use them. There are places where you need to raise the walls, the small yard, high barrier, and because you want to protect jobs and you want to create jobs. And the third is where you have no options strategically, like things like semiconductors. You need to keep investing and build your own expertise. Even on things like electric vehicles and energy storage, you need to be part of the game. Right now, we are not even part of the game.
We just have to be competitive. But take your point entirely. There's no way we can run away from the competition. But the idea of inviting Chinese capital, which is there in the economic survey, is something some Southeast Asian countries are regretting, because if they have to impose tariffs, they're also dependent on a huge amount of capital. Of course, India will not be dependent to that extent, but even that looks like a double-edged sword. We'll have to wait and see that discussion on another day. We have to wrap up on this excellent discussion we've had with Chetan and Neelkanth. Thanks much for being with us on Internomics.